In this video, we are going to talk about dividend kings. So before starting, please like this video and subscribe to this channel for our future updates. These top dividend aristocrats, firms in the S&P 500 index that have boosted dividends once a year for 25 years, have significantly more experience. Dividend kings must have increased annual dividends for at least 50 years in a row. COVID-19 outbreak in 2020 should highlight dividend kings' appeal. Several companies, including Wells Fargo, WFC and Ford, F, and General Motors, GM, reduced or halted dividend payments due to the uncertain economic climate. Investors who assumed these companies were less risky because they paid dividends were sadly mistaken, since dividend cuts generally coincided with steep share price falls. Here are some dividend kings. So let's start. Number 10. Emerson Electric. $51.5 billion market cap. Dividend yield, 2.4%. Annual dividend increases, 64. Emerson Electric, EMR, $85.90, is appealing since it is a firm with several hats. The company designs technology and engineering products for a variety of industries, including oil and gas, programmable thermostats, furnace ignition systems, food and beverage valves and sensors. Its life sciences area has recently attracted a lot of attention because EMR is part of the pharmaceutical cold chain that keeps sensitive drugs like the COVID-19 vaccination at the proper temperature. This company was founded in 1890 and made some of the first electric motors. A half-cent rise at the end of 2020 will bring the payouts to 64 straight annual increases. Number 9. 3M. $102.2 billion market cap. 3.4% dividend yield. Annual dividend increases, 63. 3M, $175.06, is the brains behind several items, including adhesives, sheets, filters, and lab supplies. While its trademarked N95 masks drew a lot of attention early in the epidemic, income investors should look beyond that to its Post-it notes, Scotch-Brite sponges, and Command adhesives and fasteners. The reality is that 3M's $100 billion size and strong relationships with a variety of industries make the whole much more than the parts. This diversified revenue stream supports rising dividends. 3M isn't immune to dividend kings' flaws. Earnings issues caused a 20% reduction in the stock price in 2018. And its dividend growth has slowed to a trickle, with a 1% increase to $1.48 a share in 2021. But throughout time, 3M has shown to be a steady dividend payer and a stable industrial investment that fits into most income strategies. Number 8. CocaCola. $212.5 billion market cap. 3.4% dividend yield. Annual dividend increases, 59. Warren Buffett began buying Coca-Cola, KO, $49.99, in 1988, right after the Black Monday disaster. Berkshire Hathaway, BRK.B, now owns a stunning $22 billion investment in Coke, in part because Buffett and company are big on dividends, and few deliver better than Coke. Coca-Cola has been paying dividends for over a century. It has increasing payouts annually for 59 years. Recent increases have been minor, with the most recent being 2.4% to 41 cents per share. Coca Powerful Cola's beverage brands include its namesake soft drink, Minute Maid juices, and Powerade sports drinks. To cater to eco-conscious consumers, the company recently announced that its U.S. bottling facility will employ 100% recyclable materials. Number 7. Johnson & Johnson. $424.3 billion market cap. Dividend yield, 2.6%. Annual dividend increases, 58. Johnson & Johnson, J&J, $158.46, is the gold standard of low-risk income stocks. J&J has a market valuation of over $400 billion, placing it in the top 20 U.S. equities, and generates over $90 billion in yearly revenue. Its 2.6% dividend yield is higher than the current average S&P wink with tongue sticking out 500 stock yield of around 1.6%. It has also increased dividends for nearly 60 years in a row, comfortably qualifying it for the Dividend Kings. Number 6. Lowe's. $118.1 billion market cap. 1.5% dividend yield. Annual dividend increases, 58. Lowe's low, $159.75, is a less expensive alternative to Home Depot, HD. After all, the latter is worth more than twice as much and pays a larger dividend return now. However, in the last year, Lowe's stock has outperformed Home Depot, returning 52% versus 21%. Also, Lowe's has been increasing dividends for nearly 6 decades in a row. The most recent was a 9% raise from 55 cents to 60 cents per share quarterly, starting October. This follows a 15% increase the previous year. Number 5. Hormel. $25.0 billion market cap. Dividend yield, 2.1%. Annual dividend increases, 55. Its products range from branded chili and pepperoni to Dinty Moore stews, House of Sang sauces, Skippy peanut butter, and many others that you may already have in your pantry. On the contrary, according to business literature, more than 40 of the parent firm's brands are no. The Dividend King announced a 5% dividend raise in November, marking its 55th straight year of dividend increases. Hormel has been paying dividends since 1928, when it became a publicly traded business. Hormel will remain a mainstay in American kitchens and dividend portfolios for many years to come, thanks to its recent $3.4 billion acquisition of nut giant Planters. Number 4. Stanley Black & Decker. $28.1 billion market cap. Dividend yield, 1.6%. Annual dividend increases, 53. Stanley Black & Decker, SWK, $174.84, sells items under its own brand as well as DeWalt, Craftsman, Mac, and other well-known hardware store brands. Also has professional-grade tools and goods. According to Business Advertising, SWK-engineered fasteners are used in 90% of new vehicles and light trucks sold in North America and Europe. Given that many organizations would be unable to function without these products and technologies, Stanley is a very safe investment. While the company's history is full with exciting mergers and acquisitions, the company's dividend history goes back to its roots as Stanley's bolt manufactory. Its 144 years of unbroken dividends and 53 years of higher payouts make it a dividend king. Number 3. Federal Realty Investment Trust. $7.8 billion market cap. Dividend yield, 4.2%. Annual dividend increases, 53. Federal Realty Investment Trust, FRT, $101.17, is a real estate investment trust, REIT. This categorization gives capital-intensive enterprises who buy real estate particular advantages. In return, these firms must return 90% of taxable income to shareholders. As a result, most income-oriented investors love REITs. While other commercial real estate stocks may pay higher dividends or have larger market caps, this one stands out for its long-term stability. FRT has mixed-use and retail properties that have been damaged by the pandemic's reduced in-person shopping. Even if some of its tenants have seen better days, the Dividend King can rely on the long-term contracts that offer reliable revenue. Number 2. Cisco. $41.0 billion market cap. Dividend yield, 2.3%. Annual dividend increases, 51. Cisco, SYY, $79.63, is a well-known food service provider to schools, hospitals, and restaurants. The coronavirus pandemic was not pleasant for SYY, albeit shares have approximately doubled from last year's lows and are returning to pre-pandemic levels. The bad news has been priced in. Shares are up around 9% since early February, when the company disclosed an 82% reduction in profits for the second quarter. SYY will regain dominance when public dining returns to normal due to recent acquisitions and vast scale. However, Cisco hasn't hiked its quarterly dividend since November 2019, when it announced a 15.4% increase to 45 cents per share. Not raising its payout by 2021 will remove Cisco from the dividend aristocrats, and consequently from the dividend kings. Number 1. Illinois Tool Works. $65.0 billion market cap. Dividend yield, 2.3%. Annual dividend hikes, 50. Illinois Tool Works, ITW, $202.18, an industrial business formed over a century ago, may not be as well known as some of the other stocks on this list. Even if you're familiar with ITW's work, you may not be aware of its extensive operations in the automotive, construction, food service, and other industries. Overall, this $63 billion industrial behemoth has many specialty sectors where few other corporations can compete with its scale. Illinois Tool Works is thus a safe long-term investment. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.